Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything personal finance, and that sometimes relates to investments, it sometimes relates to expenses, and other times it talks about philosophy or it talks about tax. Today we're going to talk about two mutual fund schemes at the start, and this is from the actively managed mid-cap category. It's a pretty popular segment of the mutual fund industry, and what we've chosen is the top two schemes by assets under management. It's a simple comparison, but not necessarily a simple one to discuss. Joining me to talk about these two schemes is Santosh Joseph, the founder of Germinate Investor Services. Santosh, there's actually quite a large gulf in terms of assets under management between the top scheme, which is HDFC Midcap, and Kotak, which is the second. Nearly 30,000 crore rupees. You can fit a whole lot of schemes in that gulf between the two, but these are the top two. What is a standout feature of both of these schemes in your opinion?
Well, to begin with, you will soon realize that in most AMCs today, the mid-cap and the small-cap funds have gone on to become the largest for the diversified equity category. It's no longer, the large cap traditionally or the flexi cap. Today, you have the emergence of a diversified equity fund being so large, but in the mid cap category. So that's a good thing. And another good thing that we have to, commend ourselves for talking today is that it's great to be talking about mid-cap funds when there's strong performance behind it. But today, in the last 1 year, when we have very little to talk about mid-cap, it's great that we are actually analyzing these two mid-caps and the top in the category. In fact, you rightly said so that there's a 30,000 crore difference between the two, and there's so much of the industry that can fit into the two. The first one being almost at 85,000 crores, the second one at 58,000 crores. These are not small numbers by any standard.
Yeah, good point. So therefore, how do you distinguish between the two? HDFC, for example, is going to have a pretty long, both of these will have a pretty long track record. What are the various metrics at the start that you would look at when you would compare these two? And then we'll delve into the details of each one of them.
Yes, both have a long track record. In fact, both have almost 15 plus years of inception if you just look at by the date of the fund. But I'm taking for today's conversation data which is 5 years and less, simply because you remember 5-6 years ago, we went through the SEBI recategorization and the reorganization of the schemes. So based on that data, when we look at the funds, both of them are not only in size, but also in performance and also in terms of number of stocks. At some level, there's very healthy competition. And towards our conversation coming to an end, I'd like to tell you what this healthy competition does to an investor. But to begin with, what is good about this is you got a very wide, diversified set of stocks that these two actually present. Now, the question is, which one do you choose and why do you choose? And we can quickly look at the numbers. HDFC's got over 75 stocks, whereas Kotak has got over 65 stocks. HDFC seems to be slightly more diversified. Whereas when you look at the top 10 holdings, you notice that there is a difference even in the top 10 holdings between the two large mid-cap funds. In fact, when I was looking at these numbers, you can see it on the screen also. When you put the top 10 holdings out, there are just two stocks in the top 10 holding which are common. Now, this doesn't usually happen in a flexi cap or even in a large cap, because there you'll see a lot more common names. But when it comes to mid cap, this is where the fund manager actually has got room for active selection and active weights. Therefore, you see just two stocks common, 8 stocks unique in both their portfolios.
What would you say about the size of the schemes in terms of number of holdings? You have 75 that HDFC Midcap holds and 65 that Kotak holds. And sometimes you would question how much of this is truly mid-cap. Would you agree?
You're right. But I'll just add another point over here. When you look at both the funds, the top 10 holdings, they're near 30%. In fact, HDFC is at 32%, Kotak is shy of 30%. So they're not very far off in the top 10 sector weight. Now, the rest, there's a long tail. Both of them have a long tail. HDFC's got a little more longer tail, maybe about 10 odd stocks more than that. it also tells you that there is depth in the mid-cap space for the portfolio manager to actually buy into so many stocks. And sometimes it's about conviction, which will be figured in the top stocks. And sometimes you're about participation, where you have a longer tail of stocks.
Okay, let's talk about that sector weightage, right? Because that's another factor to talk about. Would you say that they're more or less comparable between the two, or is there a significant difference?
Well, as you can see on the screen, you have both the sectors. The difference in one is that between HDFC and Kotak, the common part is that both of them have banking and financials as the heaviest weight. But after that, you'll start seeing a difference between IT, between pharma, between miscellaneous, and even some bit of exposure to commodities and energy. Now, this is actually what drives the uniqueness of both the portfolios. Now, if you notice, very similar structure in terms of the number of stocks, but when it comes to sector weights and it comes to stock weight, the portfolios start to diverge between each other.
Yeah, it's interesting because a lot of these fund managers very clearly stipulate, Santosh, that they don't really have a sector preference. They have a bottom-up approach to stock picking, and any sector allocation is incidental, but it will still indicate where they are placing their bets, where they are putting the money. So it's important to take note of as well. Would you also look, and you kind of already alluded to this, but portfolio overlap. There's very little between the two, isn't there?
So the portfolio overlap in terms of percentage is 26. In terms of actual stocks, without taking the weights into consideration, there are 19 common stocks between both. Now, let me remind you again, HDFC's got about 10 stocks more than what Kotak has got. But assuming you got 65 stocks and 75 stocks, that means you got a universe of 125, 130 stocks. You have only 19 stocks that are common, which means there is a broad based. Now, when I was talking about the top 10 stocks, there are two common top 10 stocks between the both, which is Fortis and Ipca Laboratories. Now, if you notice that both of them happen to be from the same sector, therefore, if you notice that if I remove that one sector out, 8 of the top 10 stocks are unique.
8 of the top 10 stocks are unique. That's interesting. What is that meant for their relative performance? First, comparing just these two and how they relate to the average performance and the best and the worst performance of the sector, of the scheme category.
Okay, so let's break this down in 3 ways. Number one, we'll talk about the standard deviation. What is the risk it carries? Thanks to HDFC having a slightly broader framework of stocks, they carry a slightly lower standard deviation. Maybe the beta is also marginally lower than Kotak. On the other hand, when you look at performance, when you look at over 1 year, 3 year, 5 year, and even on an SIP basis, clearly in a tough game, HDFC seems to be winning this game by a marginal outperformance compared to Kotak. Now, when it comes to 10-year, this is where I want to give some good news to the investors. Having these two together, or maybe let's say put it in tandem, where you didn't have the obvious choice of choosing, but you went with both of them, the returns are converging. So when I look at the 10-year trailing return, let's say HDFC would be at maybe 15 odd, even Kotak is at 15 odd. The difference is just 0.2, 0.3. So what does it tell you? You have the luxury of choosing unique portfolios, at least unique in terms of the way they're structured and they're working. 1 year, 3 year, 5 years, there will be difference in performance. But when you stretch this, if you're in the right space with the right set of people managing your funds on a 10-year basis, you're going to be a winner. Now, you're going to be a winner not by concentrating, but by diversifying. Let me remind again, 130 stocks in the mid-cap is a great set of universe to be in. And unique stocks being high and less commonality in the top 10 is a beautiful picture for a portfolio to be constructed with two guys fighting for top spot.
Okay, just to reinforce some points, you mentioned standard deviation, and we've actually discussed this on the show many times, but it bears repeating. How do you describe this? And you can perhaps look at it with an example that you've already quoted. And second, you also mentioned beta. Why is that important to look at?
Okay, first let's go with beta and then let's go to standard deviation. Beta is the extent of sensitivity of the portfolio to the market in general. Now, for example, over the last year or so, largely your mid cap has been flattish to maybe bottoming out. Now, in a scenario like this, if the beta is higher, you will notice that the drawdown on the fund will be more. And if the market does well, it will also capture a higher upside. Now, in HDFC, the beta is marginally lower. Therefore, in a flat to negative market, your HDFC will preserve your capital to that extent if beta is lower. If beta is higher, you will fall a lot more. Therefore, you will lose a lot of your capital. That is beta. Now, standard deviation actually measures the difference of the variability of return over a period of time in simple sense. So therefore, when you are in a fund with lower standard deviation, you are going to experience lesser volatility. Higher standard deviation is a higher volatility, which means the propensity to go up when it's going up and go deeper when it's going down. HDFC and Kotak both have actually very good standard deviation. But here HDFC seems to be doing slightly better, both in terms of beta and standard deviation. Now, the beauty of this exercise is when you take standard deviation and beta, that's when returns become relevant. HDFC experiencing low beta, low standard deviation, higher number of stocks has been able to edge out Kotak to deliver superior performance, which means that is the winning point for an investor. Lower beta, lower standard deviation, yet better performance.
You know, about 6 years back, and this is a large point that I want to raise with you, Santosh. 6 or 7 years back, the argument was made very vociferously to go towards passive for large cap. And I think that a lot of people have benefited purely from the cost perspective, because largely, while active fund managers over the last 18 months might have been able to beat the benchmark in the large cap space, the degree of beating the benchmark is not covered for that cost differential between passive and active. Is that argument getting stronger in the mid-cap space as well? And would these two feature in the top list for you if you were to advise people to buy a mid-cap fund?
I think you make a very interesting point. What is happening in the mid-cap space, considering that number one, we're constrained in what the definition of mid-cap is and the long list of stocks. You notice that across the industry, mid-caps tend to have a larger number of stocks, which actually is because the universe itself is much larger. Now, most of the guys are not wanting to miss out on the performance of some of the smaller weights. That's why the list of stocks increase. And all of us have this opportunity to participate both in the passive and the active equally. Therefore, the portfolio manager also is aware of that he's fighting against the index and the passives. So therefore, he's also trying to keep his fund as aligned to passive as possible, because the first goal is to beat the index. The second goal is to outperform the index, because you know there is a slightly expensive TER for an active fund versus passive. Now, I think clearly the data is out in the mid cap space that there is space and there is value that the active fund manager or even the active cost of the extra expense that you pay is now justified. This has happened even in bouts, even in large cap. There are points where the passives outperform the large cap. There have been large amounts of time where even in large cap, an active fund manager has been able to not only outperform the index, but also justify the extra expense the investor pays.
And would you say that these two feature in your top list? Quick answer.
Absolutely, yes. And I think for an investor, if you chose either of them, you're great. But if you chose both of them, it's a beautiful win-win. So we're not debating on which is good or which is bad. I think both are great for the portfolio. Now, if you chose any one of them, you're a winner. If you chose both of them, also you're a double winner.
Great. Santosh, thanks so much for taking the time. Pleasure speaking with you.
Thanks, Alex.